Hello, everyone, and welcome to our Charities SORP webinar. I'm Sudhir Singh. I head the charity team here at MHA, and I'm really pleased to be welcoming you to our webinar today, which is going to look at the key changes in the 2026 Charities Statement of Recommended Practice SORP exposure draft. Really pleased to have you here today. We've got about an hour together, and I'm really pleased to say we've got some fantastic speakers. Alongside me, I have Stuart Mackay, who's another one of our specialist charity partners here at MHA. And in a moment, I'm going to introduce our main speaker, Nigel Davies. Nigel Davies is going to take us through many of the key changes in the exposure draft to bring that to light. But we're going to allow some time at the end of that presentation for some questions and answers. So do use the Q&A function in Teams to raise any questions, queries you might have throughout the session, and we'll seek to pick up as many of those when we get to the end. The last few minutes will be reserved for that. I thought I'd just introduce you to MHA if you're not very familiar with us. We are a national firm. We're part of Baker Tilly International, a top 10 practice globally. But in the UK, we act for around about 1,000 charities across the UK and Ireland, which are the territories that the SORP covers. So we have lots of experience to share with you. And between the three of us, I think we have around about 100 years worth of charity experience to share. So hopefully between us, we've got a good understanding of some of the issues that will be faced. So please do use that Q&A. We really want this to be focused on the issues that are key for you. We're not going to be able to cover everything in the SORP. It's a big document, the exposure draft, not quite as precise as the 1995 version of the SORP, which is 30 years old, can you believe? And I remember this coming out and being extremely excited at the time because it was really transformative at the time in terms of charity accounting and reporting. Not quite sure that the 26 version is going to be quite as transformative, but clearly it is going to have some significant challenges for some. And in other areas, it's going to be more of an evolution in terms of reporting. And we'll try and draw out those points as we go through. I'd like to, though, first of all, introduce Nigel, who's going to take us through the majority of the presentation. So if we go to the next slide. And we could not have a better person to be leading on this session. And Nigel has been supporting us in terms of the support we're providing to our clients and others in relation to the adoption of the revised SORP. And Nigel formerly was essentially led the charity accounting function at the Charity Commission. And as a result of that, was joint chair of the Charity SORP making body for 8 years until just over a couple of years ago. So was very much involved in all the formative thinking that led to the exposure draft that we're going to be talking about today. We're really going to encourage you to think about the implications of the exposure draft and encourage you to respond to the consultation that goes on until the 20th of June. So do let us know your thoughts about that. We really want you to be aware of the things that can be changed as well as the things that can't. So I'm going to hand on to Nigel to take us through some slides and some of the key issues, and then we'll have a Q&A session with all three of us being able to respond to those questions. So Nigel, over to you.
Thanks very much, Sudhir. And next slide. Thank you, Kirsty. Yes, so what are we covering together in the next 40 minutes or so to allow that time for question and answer? Is the following topics, particularly focusing early on tiering. The current SORP has a reporting requirements that apply to all charities, and then particular additional things required of larger charities. There's only 2 tiers in the current SORP. We'll be exploring what the new one may offer. We'll be looking at some accounts changes together, most of which, in fairness, originate from FRS 102, with a particular focus on income recognition, revenue recognition as it's known in FRS 102, and leasing, but especially from the perspective of those renting assets, the lessees. I'll be closing my part with the timeline to the final version of the SORP prior to it going live next year, and then I'll be handing over to Stuart to take you through the concluding part of the presentation. During the presentation, I'll be trying to draw out those elements which are non-negotiable. FRS 102, when the standard changes, the SORP's role is to provide advice and guidance on how to implement that in the respective charities, but it really has no control or influence over those changes that are required, and that's particularly true of the ones on leasing and income. So we'll be looking at some actions to take because those are not going to change, and I'll try and draw out those areas in the gift of the SORP process where change could happen if you seek it, or if indeed others lobby for it. So moving on to the next slide, please, on the tiering system. As I mentioned, the current SORP has 2 tiers, about 500,000 being the cutoff, larger charities defined as income over £500,000. And what we're moving for, it's suggested, is 3 tiers of reporting, where tier 1, the lowest tier, will be recognisable, if you like, as the smaller charities as now, and the larger charity tier will be split between tiers 2 and 3, with the highest level and most detailed reporting required of the very largest charities of tier 3. Now, the basis of this cut-off between tiers 2 and 3 is currently proposed as being Companies Act based. The definition of small company includes a criterion to do with income, and that's been adopted for the SORP here. That has a logical sense as the highest level of cut-off because FRS 102 only permits simplifications for small companies, and so the SORP banking bodies aligned those, but it could always set a lower level if it wished for tier 2 than that it's proposed. So that's an area perhaps to feed in too. Now, this tiering, along with all of the other changes within the gift of the SORP committee and other changes made to the SORP as a result of FRS 102, the rationale for all of those is helpfully set out in an appendix in the exposure draft of the SORP, if it's of interest to you, but also in the invitation to comment document, which Stuart will briefly be talking about, which provides some background to the exposure draft changes that we're discussing today. So if you want to where the SORP body is coming from, there are some sources to look at. Next slide, please, if you would. So, trustees and your reporting, an overview of the tiers. Tier 1 is the first column on, and then we move over to tiers 2 and 3. And what I'd like to draw out here is this is completely within the gift of the SORP process. The trustees annual report is not set out in the standard. FRS 102 doesn't cover what's called as narrative reporting. So, in terms of this, then, it's all up for grabs in that sense. So what's going on? Well, for tier 1 charities, a lot of change. Smaller charities will find additional reporting requirements coming out of the new exposure draft SORP. And I'm going to look at a number of these. So let's go down the column 1 together. Nature of volunteers. Currently, the large charities of the current SORP have to report about volunteers. This is now going to be required of all charities. So this will be a change in reporting for a small charity. The difference made to wider society and beneficiaries, this is a form of impact reporting. Impact reporting has been recommended for charities under the SORP, but it's not a requirement. For the first time, we're going to see it required of all charities, with more detail required for tiers 2 and 3 beyond that required for tier 1. That's quite a major change. And reserves, at the moment, there's no definition of reserves in the current SORP. There was in SORP 2005, that was removed as a simplification and to allow a greater latitude given the freedom that the relevant guidance from the Charity Commission at the time gave for defining reserves. We've got a new approach with the new SORP. We have a definition, and associated with that comes some additional reporting. Elements of reporting currently recommended for larger charities in the current SORP become required, particularly for the new SORP for all charities. And also, interestingly, going concern. Going concern is a technical accounting disclosure in the current SORP to do with material uncertainties of going concern. If you find your charity in fairly fragile financial circumstances looking ahead. Now, this will be a feature of reporting too, and that applies to all charities, irrespective of which tier they're in. And last but not least, summary of future plans. This is currently only required of larger charities under the current SORP. A form of future reporting will now be required of all charities, with more detail as now required of larger charities. So you can see quite a lot of change to consider if you're a smaller charity, income under 500,000. Looking at tier 2 then, a bit of a mixed bag for tier 2. There are some elements of tier 2 reporting, which I've put in brackets in column 2, which have now been moved over to tier 3 only. So there's some compensating reductions in reporting in tier 2. So we can see this impact reporting featuring across investment policy. Now a little bit more detail required around ethical and social investing, but and in terms of risk reporting, just to say, environmental issues making a appearance in terms of risk reporting. For tier 3 then, the highest level reporting, you build on all of the changes that went on in tiers 1 and 2. You pick up, or rather should I say, retain the reporting that tier 2 don't have to do anymore. And on top of that, you will be doing environmental social governance reporting as well, ESG reporting. And we perhaps talk about that at the end if so desired. So next slide, please. So what are focusing on the changes then to think about? And just recapping then, I think the reserves reporting is quite a significant change. And there's a handout that will be accompanying this talk, which will be circulated subsequent to the event to you along with the slides. And that includes a comparison of the proposed definition against what's currently recommended practice for larger charities, and also comparing the not just the definition, but also the disclosures and how those are going to change. And I'd encourage you, all of charities on the call, and anyone you're interested in the work of your charity, to be familiar with those changes. In terms of ESG reporting, that's a whole new area and an area of itself. And I prefigure on this slide lease report accounting. We're going to be looking at that in more detail later on, because one of the elements of current approach, which is reflected in the new approach, is designating your fixed assets so they don't appear as an element of your reserves if those fixed assets are represented by unrestricted funds. Well, for the first time, as we'll see, we'll have a growth in potentially the fixed assets reported in your balance sheet, and that's something to think about in terms of the impact for your reserves policy statement, but perhaps talk about that a little bit more later on. Next slide, please. I couldn't go on through things without talking about the accounts. Not a lot of changes to the accounts, unlike the trustees annual report, where there's a lot of change. So for tier 1, you still retain the natural classification option, but for the first time in the history of the SORP, you have an illustration of it in the body of the SORP itself, so you can see what that might look like. The cash flow statement's not required of smaller charities at the moment, and it won't be required going forwards. A concession for tier 2 is that the cash flow statement won't necessarily be required of them either. They'll become optional, but tier 3 you will continue to do the full set of statements, so no real change there. So moving on then to the next slide, please, and accounts changes. There's quite a lot of detail. We're going to cover some of that in the discussion today, but I commend you to have a look at those elements of the SORP that you commonly use. So the Statement of Financial Activities, Module 4, we see a new presentation for social investments there, which is a point of detail picked up later on in Module 21, bringing the two together rather than separating out social investments across the current two categories of the SORP. They will be combined. Module 10 is now split into three modules, modules 10, 10A and 10B, and we were talking 10B leasing quite shortly. This is transformative stuff, particularly leasing, and has quite a few implications. In my own view, when we look at income together, I don't think work in progress can feature as an asset anymore. So if you've got one of those on your balance sheet, do have a look, see if you agree with me. But the right of use assets will be a new feature on balance sheets and potentially have a huge impact, as we'll see. More of that in a moment. Some technical changes to the cash flow statement if you're producing one. Again, the effect of leasing is felt there. Heritage assets, I want to pause on because although I appreciate not everyone on the call today might have heritage assets, there's a significant change. I've described it there as an option not to value, and I'd like to read from the current SORP just to illustrate what I mean by that and why it might be such a profound change. So I'm going to be quoting from Module 18, paragraph 1814 of the current SORP. Charities are not required to recognise heritage assets on the balance sheet if information on their cost or valuation is not available and such information cannot be obtained at a cost commensurate with the benefit to the users of the account and to the charity. Now, that I think gives a fair degree of latitude. That's all going as a result of a change in the underlying standard. So it's non-negotiable. It's now only in exceptional circumstances will heritage assets not be valued. So if we'll see that, I think it's quite profound. Total return, if your charity has permanent endowment, there's a change there to do with some liberalisation around using endowment for social investments. And social investments, just to conclude the slide, and this split between programme related, which was wholly to further charities purposes, and mixed motive or mixed purpose investments, which were a blend of furthering purposes and commercial investing. That distinction's gone. Everything will now be just a social investment if it's not wholly for financial gain. Next slide, please. So what are the suggested actions at this point? I really recommend having a careful scrutiny of this reserves change, because that potentially affects all charities, and it's well worth checking with the policy, particularly if you rent assets, as we'll see. That's quite a profound change. Impact reporting, this is wholly new as a requirement. So if your charity hasn't been thinking about the difference you're making and demonstrating or reporting on that, then that's quite a large change to be looking at the moment. And early thinking is probably a good thing on that. If you've been measuring it and reporting on it already, then you might want to just look at what the SORP is going to require and see whether you align with those more detailed requirements. If you're tier 3, environmental social governance reporting may be something you're doing, but otherwise it's certainly something you'll now need to consider. There are some examples of that out and about in the sector we might talk about. If you're a smaller tier, you might like to have a look at it to see what's involved. Heritage assets, so I mentioned, if you've taken the option not to value, as I've just called it, you might need to reconsider whether you're still able to do that. And I talk about new disclosures because if you've not been recognizing it, there's a whole host of disclosures that will go with recognition, and that's certainly something to think about. If you're using total return, that's a very niche area, then there's that new disclosure if you're doing social investing. And I consider your options if you're eligible on the tiers 1 and 2 for certainly the cash flow and natural classifications. Have a look at those once the SORP has been confirmed. Next slide, please. So I mentioned we'd focus on 2 areas. These are non-negotiable. So it really is worth making a start now and thinking through what these changes will mean for your charity. In fairness, the SORP making body flagged these in the autumn of last year as being something worth a look. But at that time, of course, you had no guidance from the SORP process because that was yet to be produced. And you'd be forgiven for not reading the standard because it's very highly technical, but that's nonetheless the only resource you potentially had at that time. So I'll be looking at income first and then looking at leasing from the perspective of those renting leasing assets. So looking then at income, aside from dividend and income and from interest, which is unchanged, if you're selling something, it's a wholly new approach. We've been used to common criteria across exchange and non-exchange transactions to do with entitlement, measurement, and probability. That model has gone for what are called exchange transactions, where I'm giving you payment in exchange for equal value, a good or service that your charity is selling me. So this new approach, it's probably a major rethink in terms of how you see income. It may not always change the point at which you recognize it, but that's something that we can explore. So I'm going to take a little while just to talk through in very summarized term here what this new approach is. The references and the paragraph numbers are to the exposure draft, which I really would encourage you to have a look at to familiarize yourself with those, because there's no choice to the SORP process. It won't change. First starting point is, who is the customer, or what type of customers do you have? And from that, you can identify what your agreements with them are. You might say, I don't have a contract, Nigel. Well, if I walk into your charity shop and you've bought some goods in to sell, I have a contract with you and you with me when I go and pick one up, item up, and then I go to pay for it. That's covered by consumer law. That's contractual. So there may be no written documentation, but there's a contract between us. And so consequently, you need to think about not paperwork, but the nature of the agreement, the nature of the transactions. It's very much substance over form. So identify what the obligations are. What are you promising to deliver to me? What am I getting in return for my payment? You need to determine what price I'm going to be paying for it. Now, this is probably straightforward for single items, but where you're delivering a bundle of goods and services or a bundle of services, you need to identify what those elements are. And that's why I referred a reference here to having a pricing policy. If you have a pricing policy in place, it's always good to review it in the light of this new model, because it will help you with the income recognition process. If you haven't got a formal policy in place, it might be an opportune moment to, as you think through the new approach, to actually document your pricing policy. Then you allocate the payment I'm going to make to you across what you're promising to deliver to me, the performance obligations. Sometimes obligations are bundled together. You can't separate them out, and that needs to be considered when you price things up. You need to allow for any discounts. Some discounts might be specific to a particular deliverable. Some discounts might be general across the lot, like a prompt payment discount. So you need to think about the allocation of your discounts. And also sometimes items are variable in payment in terms of the agreement, depending on how much is delivered. So there may be fixed elements of payment and variable elements of payment to do with one or more of those deliverables. And consequently, you need to identify what those are and recognize that appropriately, because recognition is only based on fulfillment. Once you've delivered something to me, I've got control over that asset, or I've received that goods and services, I've received the economic benefit from it, then at that point you're recognizing it. So whether you happen to have invoiced me or not, that's the point of recognition. And there are two versions of this: point of sale, a point in time delivered, and a performance over time. And there are different processes for recognizing between those two scenarios. Now, fortunately, you might be thinking, this is a change in accounting policy, Nigel. I'm going to have to rethink the whole way I've done it for all the comparatives, and before the year that I'm going to have as a year of comparative to work through all these changes. Fortunately, there's a simplification the FSC Financial Reporting Council have offered this, and also with leasing, where if there's any adjustment to be had, you can make it just to opening balances and not restate your comparatives. And that goes like the FRC fact sheet 9, which is one of the resources that Stuart will touch on later. That's a good place to start if you're thinking about what's the implication for my comparatives, Nigel. So let's have a look then at another form of income. Next slide, please. We'll focus on income from legacies. It would be wrong of me to suggest there's been no change at all to the income from gifts. These are gifts of money or gifts of goods or services. So I'm just going to focus on the legacy one. The big change really that has come here is that due to the underlying standard, the entitlement criterion that we're familiar with of the three has now gone. I think in most scenarios, it won't make a real difference to you in terms of how you're recognizing your income from forms of gift, but it might do for legacies. Now, legacies, there's always been a bit of latitude in the SORP because the underlying standard has allowed it. Between the point at which you recognize a legacy, you can go very early. I know I'm entitled to the under the will. I've had confirmation of that from the benefactor. I know the benefactor has now died. I'm going to book something, through to I didn't know about it. It's just arrived in the post. I got to recognize it on a cash basis. Whole spectrum. If you're tending to recognize legacies early, then you might need to revisit whether that approach is compatible with the SORP, because the recognition point now is very firmly at this probate stage, and also issues around challenges, the likelihood of being able to know how much you're going to get. I'm pleased to say there's no change for life tenant issues here. Paragraph 5.94 is the same as the current SORP. So although there's no latitude, because this affects from the standard, I don't think the changes for most charities are going to be significant on the gift side. So next slide, please. What preparatory action might you take around income? Well, I think it's very important to be distinct, clear in your mind about whether you've got an income from a gift or an income under contract. In fairness, the current SORP already highlights that in Module 5, and that's an important highlight which is carried over to the new SORP, because this 5-step model is so different. There's no common basis between the two forms of income. So substance over form, do have a look at the agreements. Now, one thing that was fed back to me when I was at the regulator very often was that the grant terminology is becoming so contractual, it's difficult to know what is a grant and what is a contract. This is now very important. So do look at really what happens when things go wrong. Is the best indicator of whether something's covered by contract law or whether it's a form of gift, albeit with strings that you have to repay some of it if you don't deliver. But do have some careful thought about that. So identify your customers where you're dealing with exchange transactions rather than gifts. Consider what the obligations are towards those customers, whether you bundle items together, whether you can unbundle items, because the nature of pricing is very important to the new approach. Identify what your customer's paying, the fixed and variable elements, if there are any variable elements. Understand the total price that you're going to pay. Sometimes standalone prices are higher than the bundled price because you're giving me an incentive to buy a bundle, in which case you need to factor that through into how you prorata the bundling price, the cheaper price that you offer me as a package deal. And there's detail about that in the SORP and also in the standard. Make sure your systems and train your colleagues, if they're on the point of sale and they're having to do the analysis for you for the accounts, that recognition's now on delivery. So you need to understand when things are being delivered, not necessarily that you've generated an invoice for them. There are lots of new disclosures, and I'm afraid there is no latitude on these. The 9 paragraphs worth of new disclosures all originate from FRS 102. The FRC has not mitigated or changed any of them. So I'm afraid if they apply, you have to provide all that information, and it was too voluminous to summarize here. But it's well worth having a look, because the new SORP, of course, repeats it all for you. If you're old school like me and you relied on timing of the invoice, then I'm afraid that's no guide to you at all, because the invoice could be an element of prepayment by your customer. So that doesn't really help that much anymore. And for that reason, I think good old work in progress is a thing of the past. But you can treat, as you can now in fairness, at certain instances, incurred cost as an asset prior to being able to go on to deliver and perform the contract. So there are, I think, quite a few things to think about on the income side. I promised to look at leasing. So next slide, please. I've covered quite a lot at pace. I'm going to spend a little bit longer on the leasing topic because it's quite complex. And to start with, let's set the scene based on where we are at the moment from the point of view of people renting, your charity renting or leasing an asset. For charities that rent out assets, the lessors, I'm pleased to say your accounting hasn't changed. It's been freshened up a bit in terms of disclosures, but the underlying accounting hasn't changed. It's only for those charities, which is, I guess, majority that rent assets that are affected by this transformative change. So the current approach, which I'm familiar with, having trained in the accounting in the 90s, and is the following disclosure. Lease payments recognised as an expense in year for operating leases, and for operating leases, then an amplified note providing total future minimum lease payments on the non-countable operating leases for each of the following periods, not later than 1 year, 1 year to 5 years, and more than 5 years. So fairly straightforward. I think you'd agree in terms of the presentation, the information you have to provide. The new approach is fundamentally different. It is transformative, it is also complex, and because it comes from the standard, it's also non-negotiable. So there's some whole new terminology to get our heads around, and I'm going to spend a little bit of moment on this because it may be wholly unfamiliar to many on the call. And there's 4 terms I'd like to pick out. All the terms I'm pleased to say I'll set out in the new SORP, well worth a look. So the first term is right of use asset. An asset that represents a lessee's right to use an underlying asset for the lease term. What am I going on about? Well, I think the underlying philosophy here is that when I enter into a lease agreement with you, I've got an obligation to pay you a certain amount of money over a number of years, and I have exclusive right to occupying the space, using the vehicle, using the equipment for the purposes of my charity. And therefore, I have use of that asset for that time. The right of use asset, it gives a value to that booked capacity or booked time and puts it on my balance sheet. It says, Nigel, this is the total value of things that you've signed up for. That's an asset to you because you're going to be using that to further the purposes of your charity. You'll put a number on it. That number, though, is not the total value, cash value, of the payments I'm making to you. You're kindly leasing this asset to me. No, the liability is, the lease liability is not that. That's because in for-profit commerce, when working capital is tied up in something, there's a financing element to it. So it's deemed to be that the payments I'm making to you and leasing the asset to me are made up of 2 things. One, if you like, a repayment of a liability, the working capital, and the other part is interest. Time is money. So we now have a lease liability recognized at the point that I've entered into the lease arrangement with you. I have a right of use asset, which is of probably a higher number, and almost certainly a higher number. And then my lease payments to you, I'm now analysing in my accounts as a charity between a repayment of the principal, the lease liability, paying that down, and interest. So my accounts are going to show different things. The interest payment will be in my accounts. The lease liabilities are cash movement on the balance sheet. And is there something missing? Yes, there is. Depreciation. An asset is depreciated. I have a right of use asset that's depreciated over the lease term. Lease term, what do I mean by this? Lease term is the aggregate of, forgive me for this detail, a non-countable period of the lease, that's very important, periods covered by an option to me perhaps, to extend the lease if the lessee is reasonably certain to exercise that option. So I've got to think at the inception of the lease arrangement with you whether I'm going to accept, likely to exercise my option or not. That will affect how much capacity I'm buying, which affects the right of use asset value, and it all affects how much the lease liability is because I'm paying for longer if I to exercise my option or likely to exercise my option. And C, periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. If that sounds a bit legalistic, I'm afraid it is. Lease accounting is a complex contractual area and will need quite a lot of thinking about, because a lot of this detail I've just spent time talking about, we've not had to consider up to now. When I did my operating lease disclosures, I just needed to know how much am I going to pay you this year and how much in future years, analysed as I mentioned, will I be paying you into the future. We've already had some complexities here. So the next stage, I think, is not everything when you're renting something is likely to be a lease. Sometimes it might be a simple license for a year or less, and the SORP draws that distinction between a license and a lease. A license will usually be a non-exclusive use. So, let's say I'm a charity using a sports hall in a leisure facility. Other people will use that sports hall as well. I may have a regular booking, but that's not an exclusive use of that facility. Others use it. It's under the control of the facilities management organization. So that's a license arrangement. That doesn't fall within this complexity. I just book my rent for the period. I have to identify the date I go into each lease arrangement, the lease term in this non-cancelable period. I need to do this calculation now of what value have I bought in entering into the agreement with you, this right of use asset, and I need to identify what the lease liability is. And the lease liability isn't one element of the total element that I'm going to pay you in terms of the payments due under the terms of the lease, the other element being the financing aspect. So I need to work that out, and the SORP gives you an indication of how to do that. I need a depreciation policy, of course. If I've at the moment got no assets, but I'm just leasing something, now suddenly I'm in the realm of having to have a policy for the first time for a right of use asset. If I have other assets, I own premises and I lease premises, then I have an existing policy which I would apply, subject to the caveat around what is the lease term and the non-cancelable lease term, because that may affect the term over which I can depreciate the asset. After all, I have to have use of the asset. With assets comes impairment. So, of course, we have to do an impairment review now of leased assets as well as the assets I own. And there are many, many disclosure requirements associated with this new approach. I'm sorry for this complexity, but there is nothing any of us can do about it. Next slide, please. So, what might we do about it in terms of possible actions? Well, I think the first thing to do is have conversations. There's a very good background to Stuart and Sudhir there about having conversations. What do I mean by that? Well, find out what things are being rented. I would use the term rented, not leased, because people might go around looking, colleagues might look around looking for lease agreements. Now, a lease can be a component of another agreement. The FRC, Financial Reporting Council, makes that very clear. So that may be a red herring. Look for what relationships you have with third parties where you rent things and identify what things you're renting. Now, if you're a small charity, it might be this is known by the trustee body or the trustee body in a small group of employed staff. You can get in a room and have that conversation. If you're a large, complex organization, you may have delegated authority across your financial decision-making within the and entering into agreements across the charity. And you'll therefore need to have a conversation now to start to identify what paperwork do you have, what understanding do you have. And in the handout that accompanies this presentation, I have a scenario which is deliberately slightly vague about, and it's an unwritten scenario. So it's a verbal agreement. It's still an agreement. And so we can explore what the nature of a lease is, because it may be something that's not been documented that needs to be. So identify what all these assets are that you are leasing, and then identify whether it's a license or a lease, and that's very important, because if it's not caught by the leasing arrangements, then that's complexity avoided. There are some exemptions. They are very limited, but they're very useful. And the three exemptions are identified in the SORP. They are to do with short leases or rolling short leases. That's a lease of a year or less. you can just treat it as a rent charge effectively. That's a useful one. Low value. The FRC, Financial Reporting Council, have been more generous with their interpretation of this than the standard they've interpreted themselves. But they do have a long list of things you can't include. But low value items is not to do with its relationship in value to your balance sheet. It's to do with the intrinsic value of the item itself. The SORP makes a few suggestions as to what those might be. Low value items, you don't have to do this complex approach. You can keep the traditional approach you've been following up to now. And nominal leases. Now, this is an important feature of the charity world. You may have arrangements where it's a peppercorn lease. It's £1 or £10 or £100. And both the FRC and therefore the SORP recognises that you don't need to book this as a commercial lease like this. Instead, the SORP sets out a different framework for disclosing the existence of that arrangement without going through this complexity. So look at the exemptions, look at what you're leasing or hiring, and then see what you've got that's caught by this complexity. The Financial Reporting Council issue a fact sheet 9, which offers some simplifications, because again, you might be thinking, Nigel, I'm halfway through a lease and now you've told me I've got to do all this, and I'm going to have to go all the way back to know what it would have been and then work out where my comparative year is and then work out what happens in the year. Now the FRC said no, you can just deal with recognition in the year first report, but you have to adjust your opening balances, because at the beginning of that year you now have a right of use of asset which you're going to have a depreciation charge against. You're not going to book a single expense for rent. You're now going to split that between reducing a liability and paying interest. So the FRC have offered a simplification. Fact sheet 9 is a good way through it. And if you might say, I've only got a year to go, in which case the FRC is subject to a caveat to do with ability to exercise an option to buy it. Subject to that caveat, you could just say that's your short lease. I don't have to worry about those either. So do have a look at whether you can do any of these exemptions. Do have a look at the simplification that the FRC are offering with that fact sheet. And then for those that you can't avoid having to apply the new approach to, I'm afraid with a heavy heart I have to say you have to do all these calculations, looking at what the residual term of the lease is, what is the non-cancelable element of that term. Is there an option? Are you going to exercise that option or not? And that affects what residual you have as a right of use asset, and that helps you in terms of identifying the amount of payments you're going to be making, then splitting that between the liability and the interest. And that is a big ask. But unfortunately, that ask is being made of the sector. If any of you are members of the ICAW Charity and Voluntary Sector community, they have a whole webinar devoted to this new subject of lessee accounting leasing on the 15th of May. And I think there are still places available to sign up, because that's an online live presentation on the 15th of May. So do have a look at that as a resource as well. So coming into land for my contribution. Next slide, please, on other changes. So a new SORP body, new SORP committee, they take the opportunity to look at the text and see, is it really clear? Could it be improved? So there are some bits of text which are still there but may have moved. So familiarity with the new text is a good thing. So what I mean by this, well, elements of commitments and elements of the current module on balance sheet have been moved into a new module. Apologies there, I've put 10, but it should be 10A. I do apologize. Module 10A, where they put all that material together, hopefully making it clearer how you do with commitments, contingent assets, contingent liabilities and provisions as one package. And they're also reordering things within modules. So some text has been moved around. I've given module 2 there to do with fund accounting, and module 21 is social investments, module 11 is financial instruments. You'll find they've reformatted and moved around. There are some new section headings. So if there's elements of the current SORP that you rely on, it's well worth looking at the new one to think, well, have they just moved something? Am I okay? Or is there a finer point of detail that Nigel hasn't covered that does affect me? because we've not been able to cover everything on the call today. So I'd ask the concluding action really is to look at this, and also the elements of should reporting. So for the first time, if legacy is a material thing, then I think it's tiers 2 and 3 are encouraged to report on material legacies in their and their approach to recognising legacy income in the trustees annual report. And that's a should, not a must. So there's some nuances of changes that are well worth considering. Even you say, well, I can't do this by June, Nigel. You could still look at it over the summer, because many of these things won't change. And if they're to do with FRS 102, as I've said, they can't change. So my concluding slide before handing to Stuart, please, the next slide, please, on the SORP timeline. So when's all this going to come to fruition, and what about early adoption? Well, we're at this stage now of consultation closing on the 20th of June. After that, the SORP body will, together with the SORP committee, will deliberate on the feedback. There are over, I think, 42 questions in the invitation to comment. You don't need to answer them all, but they'll need to deliberate on all of that material and then identify what final changes they're going to make. All SORP statements of recommended practice are approved by the Financial Reporting Council. I believe, unless it's changed, this SORP actually has to go for the full board as part of the final process of sign-off, because it involves regulation. So it's quite a detailed scrutiny by the FRC as a result. That hopefully will pop out with approval by end of September, which leaves the SORP being published somewhere in October. That's an ambitious timeline, but as you can see, there's not a lot of time available before we go live for reporting periods beginning on or after the 1st of January 2026. In terms of early adoption is, since the standard's been out, FRS 102, since September last year, you can say, well, Nigel, we've got to go early, best to get ahead on these things. Well, all I draw your attention to is in section 1, paragraph 1.14 of FRS 102, the standard itself, there's a caveat around early adoption. Although early adoption is permitted for reporting periods ending on or after the 31st of December 2012, that's only if it's not in conflict with the current SORP. And I think perhaps it is. The current SORP has a common approach in terms of recognition criteria between exchange and non-exchange transactions, which are measurement probability and entitlement. Well, I've just described that's gone for exchange transactions, and as for lease accounting, we spent quite a lot of time contrasting those two approaches. So I'm not sure that early adoption would be something I would recommend, because I don't see it being compatible with the current SORP. But at that point, I think it's germane for me to hand over quickly to Stuart. Thank you.
Thank you very much, Nigel. If we can go on to the next slide, please, Kirsty. So we just wanted to make available, make you aware of the some of the free resources that Nigel has talked about there through his presentation. We have a number of the fact sheets there and links to them. We also have some guidance there on impact reporting and a smaller charities fact sheet. All of this will be available on our website as well. Next slide, please, Kirsty, because I'm aware of time and we're keen to get to the Q&A. So as Nigel says there, the SORP consultation closes on the 20th of June. We will be submitting our response to the 42 questions that they've asked us, and lots of those are discursive. So if there's things that we want to see in there, more appropriate guidance, for example, and indeed the current SORP has a number of information sheets and fact sheets and so forth. So I think we'll be looking to make sure that appropriate guidance is being given out, especially in the area of revenue and lease accounting, which, as you can probably tell from today's chat, gets quite complicated quite quickly. A number of umbrella bodies are also putting through their responses, Charity Finance Group. So please do get in touch with them if you want to add your thoughts to maybe a sector or an umbrella body, or indeed have a go at the consultation yourself. You don't have to answer all 42 questions. You might just think an individual response on any part would be useful. So there's a link there as well. So I think I'll hand over to you today.
Thank you very much, Stuart. And Just while everyone just reflects on that fantastic presentation from Nigel, I don't know how he managed to cover so much in so little time. So thank you, Nigel, for that. And just to reiterate what Nigel said, all these slides, a handout, and a recording of today's webinar will all be on our website shortly in the next few days, and we'll be following that up. So you'll have some resources there to refer to as well. So whilst you're just thinking about those questions, do think about responding to this consultation. I think it really is quite important. As Nigel said, there are things that are unchangeable because they're built into FRS 102, but there are things that I think it's worth us reflecting on. We haven't covered every element of the changes in the SORP, but there are quite a number of things that are charity specific that I think it is worth us thinking about. So just think about that papal conclave. Think about whether you want some black smoke or some white smoke with some of those issues, because I think it's worthwhile the SORP committee, even though there's limited time to do so, that they consider any changes that would be better for the sector. Because I think, I was comparing my 1995 SORP, 95 pages, wasn't that very good, including a model set of accounts, with our 300 odd pages in the exposure draft. Surely there's some simplification because there's a lot of additional complexity. Just one or two questions then arising that I'm going to pose to Nigel and Stuart. So first of all, Nigel, you were talking about leases, and you talked about the exemptions for smaller leases. I think some of the examples in the SORP talk about sort of small bits of equipment. Do you think in reality for charities, this is going to end up being focused on land and buildings, property leases in the main, or do you think it's going to have a wider implication for many charities?
Well, dealing with the first part, low value leases at the moment, I think the underlying thing was photocopiers. If you're renting computer equipment, possibly lighting equipment or some theatrical equipment, the FSC sort of basically says if it's not the value of any of the items we excluded, like cars, boats, plant, which tends to be, I guess, thousands of pounds, then it could be low value, and therefore if you're renting it, don't need to worry about it. So those are probably quite useful tactical things to avoid having to do so many calculations, or even by having to group things together and do a calculation for a group of items. So it's useful. The complication around land and buildings is very often arrangements might not have been fully documented. It's probably less of a accounting issue if it's to do with these nominal or low consideration rents, where perhaps one charity in furthering its purposes gives a very low rent to another. But unfortunately, there's not a complete get out of jail clause. If there is a degree of commerciality about the lease, so it's not a nominal rent, but it's a discounted rent or reduced rent, then if it's not caught by the commercial aspect of being some form of lease discount, then it's potentially caught as a social investment lease. And unfortunately for those, the SORP does go through this in a bit of detail. The FIC says, well, there are two elements to that transaction, Nigel. The first element is a grant, because the grant's equivalent to the payments you're not making for the asset I'm leasing to you at cheap terms. And the balance of it is the commercial lease. So you have to do a complex calculation for me, Nigel, showing the gross value of the right to use asset as if you paid me the full amount, and then show me a lower lease liability, because after all, you're only paying me a much smaller figure, which associated with that is an element of deferred grant, because the balance of it is deferred grant, or interest on the liability that recognises that commercial element. So that's going to be fiendishly complicated to work that out, and may involve looking at agreements to see whether you can persuade your auditor or MHA colleague that it's caught by the nominal rather than the social investment aspect of leasing. So I'm afraid there's a lot of detail in leasing that we've not had to worry about before. I'm very sorry about it, but there's no way around it.
Yeah, thank you, Nigel. Do carry on with those questions. Use the Q&A function. Just picking up on that, both of you, yeah, it does feel to me that the cost of preparing financial statements going forward for charities, with all this increased complexity, particularly talking about leasing, but also some of the income recognition, is going to require more time and effort and potentially costs, therefore, for preparers of accounts. So do we think that's the case? But also, do we think this is going to have an implication on audit and independent examination costs, because there's more complexity to be for everyone to get their heads around? So it's the compliance cost aspect of the revisions in the SORP. Can I start, Nigel, with your thoughts on the preparing costs, and then Stu can talk about the auditing costs?
Picking that up, I think they're dealing with independent examination first. I think this is a major challenge to independent examiners. Even qualified independent examiners will need, as I did when I was a contractor, getting my head around this new approach. And so for trustees, it's important to have a conversation with the examiner to see whether really they want to continue with you as your examiner if you're leasing things. Because if you're relying on the examiner to assist you, you might need to find another examiner who's more conversant with the new approach than your existing one, who may be a volunteer. So there may be a cost to that, because examination may be a chargeable thing if you're getting an expert to help you, rather than a volunteer examiner, as you might be now, for nothing. So that element may go up. In terms of what I've just gone through, in terms of thinking through your pricing policy, thinking through where all these agreements are, that's going to involve time. That's going to be either at the very least be a non-cash distraction, but in terms of then putting the accounts together, it's going to extend your process, and maybe you need to get support or assistance. You might need to have a conversation with your software supplier around what the product supports in terms of this new approach, perhaps even buy some more software associated with some of these leasing calculations, or find out an appropriate spreadsheet solution, and that's going to involve cost and effort. So I think there's no way around it. The transition is a big ask. After that, it should flow smoothly, but because of all of this detail, it's probably never going to be as easy as it's been before.
Okay, thanks, Nigel.
Yeah, and I think from a sort of audit perspective, it all depends on the complexity of each individual. So if you have a lot of lease agreements, then that's a lot of work to go through and check the underlying assumptions that the preparers have used, the information that they've used in the calculations, discount rates, and so forth. There's a lot of judgment in there as well, which is quite difficult to sort of navigate. So it will ultimately depend on each charity's circumstances. I think, some of the thoughts behind revenue about whether the point of recognition will actually change is something that just needs to be thought through. And I think you can start from a theoretical basis, and then you can go towards applying it to each of your revenue streams. So I think if you start having the conversations early on, you'll then get a feel for how complicated this is going to be for you, and then have that conversation with your audience.
Thanks, Steve. I think there are one or two more questions raised in the Q&A. I think what we'll do is we'll take those offline as we're coming to the end of the session. But just picking up on what Nigel was talking about in terms of sizes, I just want to remind you there are some other consultations going on at the moment that are really important as well. So there's the financial thresholds for charities consultation that is ongoing at the moment, covers things like the thresholds for audit and independent examination, but many other areas, including some of the fundraising thresholds. Do have a look at that, because that interacts, I think, in many ways with some of the things that we've been talking about today, and thinks it has an implication about those compliance costs. That ends on the 12th of June, so a similar time frame. Also be aware there are other things changing. There's the fundraising code has been revised, due to be adopted in November this year. We have a governance code expected later this year. and something that Nigel's been involved with, but so is MHA. Is the International Financial Reporting Standard. There's a new international non-profit accounting standard, INPAS, due out later this year as well. Lots of things changing. So do stay in touch with MHA. Subscribe to our newsletter. We issue something every month that gives you some details. You have a contact QR code there on your screen now. Please do use that to contact us. But I think all it does is it remains for me to say thank you to Nigel for an absolutely fantastic presentation, and to Stu for supporting me in responding to your questions. Thank you for your attention, ladies and gentlemen.